Good day, everyone. This is Blue League Markets. Welcome to our private lesson. This is lesson number 8. And on today's video, I just want to introduce two concepts, BOS and chalk. I'll make this video short. These concepts, I'm just going to introduce them now. Then later on, I'm just going to show you how we apply them on the Forex market. So just to make a summary on the previous videos, the previous videos I spoke about how the market makers place two orders on an order block. So they will open a buy and a sell at the same time, and it will depend where they want to move the market. For example, if they want to have an uptrend, they'll open a buy there. Then they'll present some sort of liquidity, can be trend line liquidity, or it can be any type of liquidity. We'll do type of liquidities as time progresses as we move on to other lessons. Then after that, they'll come back, mitigate whatever they mitigate, then they'll continue with their proposed move to the to the upside if they were having an uptrend initially. But if it is a downtrend, they will do exactly that. So it will come and open a buy and a sell. I call this point an order block. This is where they will open your buy and sell order. So now, in order for them to come and mitigate their sell orders, they'll come back down, and you'll see the market do this. So usually, the reason they do this is so they generate enough liquidity here, for them to be able to move down and take everyone's stop losses. So they'll present some sort of a trend line liquidity. It can be double top, it can be double bottom, it doesn't matter. Then afterwards, they will chow all that liquidity on their way down, and this will be a quick move. So usually as blue league markets, how we trade is we wait for all this move to happen. We only join in when the market makers come and mitigate. This is the point we actually take our first trade, and we exit there on the top. So this is some of the things I summarized on from lesson 1 to lesson 6. Then I also spoke about imbalances, that an imbalance happened between three candle number 1, candle number 2, and candle number 3. So what happens is you'll have three candles. One of them is going to be an engulfing candle, like in this case. Then the distance between the wick of the first candle and the third candle, that's your imbalance. So you'll find your imbalance somewhere here. I explained this thoroughly on the lesson which I recently posted, which is lesson number 7. Please forgive me because of these adverts. I'm using another account which is not paid. So those are some of the summaries I did from lesson 1 to lesson 6. Then I also showed you a strategy on how you can use your imbalances together with your liquidity to trade. So I already showed you two strategies. Well, I don't really like calling them strategies. It's just an approach to the market. Enough of the summaries. If you don't understand everything I just said now, what you need to do is you need to go and watch from lesson 1. Please take this as slow as you can so you can understand every concept that we explained to you. On today's case, however, we're going to talk about break of structure and change of structure. It may not make sense now, which is fine. I just want to introduce the concepts, and we'll move on to the charts in the next lesson. So BOS, every time you see BOS, just know that it means BOS, just know that we refer to is as break of structure, is when your structure is broken. Break of structure. And every time you see your chalk, just know that we're talking about change of structure. So it's when the structure is changing from an uptrend to a downtrend. Change. Sorry about that. Change of structure. Wow, why is my spelling so bad today? Change of structure. So yes, this is what it means BOS means break of structure, CHOOCH means change of structure, and you can use this in the following way. So let's start with break of structure. So a break of structure happens in an event where, let's say, you have a market, it's going up and it presents internal structure. There's what we call internal structure. Then afterwards, it mitigates whatever it mitigates on the bottom, or it takes out inducement and liquidity. After doing that, it goes up. So this is break of structure. Let's say you had an order block or inducement or imbalance here. So the market went up, then it came down and did internal structure. Then afterward, it broke your recent high. So here you'll have an higher high. I'll explain higher high and lower. I'll explain swing highs and swing lows in the next video, because they also deserve a video of their own, because they're very important for you to understand smart money. So in this case, when a swing high is broken, we have what we call a pause, which is your break of structure. So we'll have a break of structure to the up. So this is what happens. What happens is when you have an impulse, you have an impulse here. So this is our impulse. Um you have an impulse, then a pullback, then an impulse. So it's when you have continuation. So a BOS happens when you're having a continuation, right? Then a chalk happens when you're having a discontinuation, when your market is changing from an uptrend to a downtrend. So for this, a downtrend is also true. So I'll name this liquidity. Now you guys may realize something, that I always include liquidity. I haven't taught liquidity, but then I always include it in all our lessons, so that you understand that it's the source of this whole thing, right? Now let me just draw a continuation of a downtrend, so that you can also see how it happens on a downtrend. So let's say you have an impulse. Now the market is correcting itself. Let's say we have a trend line liquidity pool, right? So it wants to go and mitigate something. Then it mitigates whatever it mitigates. Then it chows everyone's stop losses here, because now people were assuming that there's a trend line going up. Then it continues and it breaks your swing low, right? Let me just move that. Then it breaks your swing low. So we'll have some point of interest there. It's either it's imbalance, it's an order block, or um anything like that, right? Then afterwards, this is where we'll have our break of structure. So the market has broken structure to the downside, meaning it's continuing its downtrend, right? So we'll have a pause there. So now one thing you should realize is the market will keep doing this in form of steps. Let me just continue this and show you where the next break of structure will happen, right? The market will then go back again, create some sort of liquidity. Let me do a double top liquidity. Then it will create a double top. Then people are just going to leave their stop losses here. Then it will come, let's say here, do a double bottom. Let's say it wants to take people out simultaneously. It will first take the double bottom stop losses, then go and take those double top stop losses, then continue and break structure down, right? Meaning at this point, we're going to have some sort of what we call liquidity, right? We're going to have some sort of not liquidity per se, an order block, right? Our liquidity is going to be here. This is where our liquidity is. Liquidity up, and we're going to have liquidity down, right? So ultimately, what I want to show you is people really think we have a trend line. Let's say people really think we have something like this, but in mere fact, we don't really have a trend line. What happens really in the market is that the market makers are just, they keep on coming down to collect their orders, and it will present itself as some sort of a trend line. Let me just show you how this happens. Let's say the market is coming like this. It will present a swing low there. It will you know, create like liquidity. Let's say it create other liquidity here. It will go mitigate itself there. It will go break structure. It will go break structure. After breaking structure, it's going to create some liquidity. Let's say it create trend line liquidity. And when people think it's an uptrend, it's just going to mitigate something, then break structure, just like that, just like that. Let's say it has a consolidation phase, then it breaks when people start buying, breaks and retest when people start buying thinking it's going up, it will then chow them and it will break structure. So in a market, when people say this, they think that the market is actually on a downtrend. What happens is that the market makers just keep on correcting themselves. You'll get an order block there, you'll get an order block there, where it corrected itself, and you'll get an order block there. So the minute you understand this, that's where you'll be able to start realizing that the market is actually doing this. Then you'll have a break of structure there, break of structure there. You'll also have a break of structure here, and you'll have another break of structure there until the market breaks. Okay, let me break the structure there. Until the market comes and breaks this swing high, because the market is having a downtrend, it's not supposed to break a swing high, it's supposed to keep on breaking swing lows. Now immediately the market goes and breaks your swing high. Let's say it does something like this. The minute the market comes and breaks your swing high, that's where you start having your change of structure. I'll explain this much further on charts in the next lesson. For now, just understand how a choke happens. So that's where the market is having a choke. Now, what happens as a continuation from here is that the market would have left some sort of an order block here, right? Now it will come down and it will have a retest and people will start buying because now they will see that there's a retest. It will retest again for the second time. Maybe it will retest for the third time, just get more people buying. It will keep on retesting, and the next thing is people will be leaving their stop losses somewhere there. Then it will because now it's a retest, they will say it's a buy, then it will chow everyone's stop losses, mitigate what it needs to mitigate, then it will break this structure to the up. So now after chalk, what happens is you continue having your pause. So chalk only happens when the market is changing from a uptrend to a downtrend or from a downtrend to an uptrend. Then you'll have a pause. So how we trade it in blue league markets is we wait for the market to do all of this. We only jump in when it comes and mitigates. So our orders will look something like this. And for someone who doesn't understand how we trade, they will basically think that we're trading um, a trend line. But in mere sense, what we're trading is we placing our order blocks, trading our order blocks. So we only trade whenever the market comes and mitigates. That's where we jump in with the market makers, something like this. Meaning then you'll have another order there. But the minute the market presents a shock, our next move will to wait for the market to come and mitigate there, because now they will have a buy and sell orders there. Then we'll target where the high presented. So yeah, it looks complicated now, but in the mere fact, it's not. It's just breaking structure. The minute you start understanding what or what are swing highs and swing lows are, is the minute you start understanding how this break of structure, change of structure works. Another thing I'm gonna explain in the next coming video, I think it's gonna be lesson 12. I'll be explaining internal structure. Then in lesson 13, I'll be explaining your buy side and your sell side, which is your they can call it many ways. You take your Fibonacci retracement, you just leave all the levels, you focus on your 0, 50 and 100. Then you need to understand when a market has a full pullback, because for example you might think that the market has completed its full pull. Let me just delete that. You might think that the market has completed its full pullback here, um and then you get surprised when the market comes and completes a full pullback here, and you ask yourself why. So you need a Fibonacci retracement, because a complete pullback needs to happen after the 50% mark, right? I hope everything I explained in this video makes sense, but I'll keep explaining more as we progress to other videos. I'll re-explain this using the charts in the other videos. This is Blue League Markets signing out.